our guest, and welcome to the COB, Bas Kooijman from DHF Capital, who actually joins us from Dubai. So Bas, just give us a bit of an understanding of what's happening in the part of the world that you're in.
Oh yeah, it's actually a very rough 1.5 week already in both the whole situation in Dubai as of course also in the markets. So at this moment it is a lot more under control for our feeling than of course at the start. And yeah, we have all been just working from home and waiting for all the issues to dial down a little bit more.
Absolutely. And I guess what we did see overnight was a reversal somewhat in that wild crude trade on the back of President Trump hinting the war could be over soon. Where do you see, or how much more volatility do you see here occurring in the crude market?
Yeah, on the oil market, they really surprised us yesterday with the price jumping over $100 a barrel. We did see yesterday sticking above that 100 price for quite a while. Basically, we see that the oil can go to about 120, 130 if all the tensions stay. If those tensions are being resolved, the long-term trades, the long-term forwards on oil are still trading about 65 to 73. So the nice thing is that if we don't see adjustments yet on the futures, we do believe that there's still a chance that it will bounce back to, let's say, normal from the prices from 1.5 weeks ago.
Yeah, I mean, there's a lot of focus here on the picture, though, in terms of what it means for global inflation, Bas. How do you see that playing out? What is it going to mean potentially for the Fed?
Well, from the Fed perspective, I think that rate cuts we can maybe forget for a while, even though of course they were planned. I think we are not trading oil at the DHF, but we are looking at oil as like kind of the global standard for all other things you trade. When we are trading gold, when we're trading stocks, it's extremely important what that oil price is doing. And when the oil price would have been hovering around 80, some companies would already adjust their prices. When they adjust their prices, when shipping is more expensive, when basically everything gets more expensive, we will see inflation grow. And if it goes to 100 or stays above this 100 level and it stays there for a while, we'll see flights becoming more expensive, travel becoming more expensive, energy becoming more expensive, like day-to-day expenses will go up for everyone in the next 2 or 3 months. Inflation will rise, and then yeah, we will have to see what that does with the stock market if the companies can keep up with this kind of energy prices.
Yeah, it's a lot that's happened in the last 5 years or so, isn't it, for the global world order to contend with. So when you say what you are trading, I mean, if we look at gold, if we look at the US dollar, the greenback is certainly showing signs here of being a safe haven play again.
Well, gold always is a safe haven basically, and we are expecting the base case target to be 5,400, 5,600 for the year. Now, of course, we've seen this kind of crazy push already again in the first 2 and a bit months of this year. Bullish scenario is maybe 6,000. But if the tensions stay, I've seen models getting gold to $8,000 an ounce. Like, it's just all about the global tensions, and that if we don't see any rate cuts, if we see the geopolitical not de-escalating, I see some profit taking on the gold side for people who have been enjoying this gold run, but it's directly being eaten up by just general buyers. Central banks are still buying, hedge funds are still buying, so yeah, it's still on the rise.
What does it mean more broadly for risk off sentiment, Bas? I noted that JP Morgan says that they see a potential 10% correction for the S&P 500 amid this war premium.
Yeah, so I think that we can also expect corrections on the gold side. We expect about 8 to 12% correction on gold. It's kind of always when there is such a big run on a certain asset, is that there is a natural or technical correction. If we see a correction on the stock market, that means that the funds always have to go somewhere, and it's not that literal anymore as it was before, because we also have different asset classes like crypto nowadays. But basically, I see it as a weighting scale. So when the money goes out of the stock markets, where does it go? And that mostly goes into more safe haven assets, for example, gold. And then when the stock markets normalize again, the money moves back. So that's what we will have to see, which one goes first. And for that, we are looking simply at the oil price at this moment to see how those companies are going to survive the higher energy prices.
All right, Bas, really appreciate your insights. Thanks so much for joining us from Dubai. Bas Kooijman from DHF Capital there. And of course, a lot of volatility. I will note that ClearBridge is indicating that history tells us that buy the dip may come through, given all of the volatility that we have seen recently caused by the oil, or the war premium, if you will. All right, getting back to